This is Retirement Keys with Anthony Congemi from Crescent City Retirement Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Anthony provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Retirement Keys with your host, Anthony Congemi.
So, very good. Well, thank you so much for joining us, and welcome to the 5 Keys to a Stress-Free Retirement. Our radio show is Retirement Keys. I'm Anthony Congemi. And we really appreciate you joining us every week on this beautiful Sunday morning. We have Tony Shore with us, our fabulous co-host. Tony, thank you so much for being here this morning.
Yeah, no problem, Anthony. Thanks for having me on the show. I'm excited about this one. We're going to talk about what's going on. I mean, there's a lot out there. People are concerned about inflation and the rising prices. Like, I see people all over social media posting pictures of gas prices and talking about how high gas prices are, and prices of cars have gone up, and food at the grocery store. So we'll talk about that a bit, and how the 5 keys to retirement and financial planning can help folks hedge against inflation. I think that's important. But before we get into that, I've had a great week. It was my birthday last week. That was fun. Celebrated with the family. How about you, Anthony? How have you been? What's been going on over there?
Well, we're just off of Mardi Gras, so that's kind of it was a good time, Tony, because I think that most people, at least the ones that were out on the parade routes, were, we were kind of ready to, kind of get back to some normalcy.
Sure.
And last couple of years we haven't had our Mardi Gras down here. And so, I mean, even if you're not a parade goer, I mean, families get together, they have boil crawfish, they have time off, so whatever, you enjoy doing with that time off, it was nice. I think it was well received, and people really, were happy to get back to some normalcy. So that was good. And, Tony, we've just been, with all, as you, mentioned, and as we talked about before we started the show, with inflation on the rise, and, then, of course, some of this, these geopolitics and what's going on with Ukraine and Russia, and, some of the turmoil there. I mean, it's got people, thinking about their retirement and their investments, and, if they have all their ducks in a row. So, I mean, it's really just been a little uneasiness, I guess, Tony, with all of that.
Yeah, for sure. I think that makes sense, that there is some uneasiness out there, but it's too bad all this is happening with the Ukraine situation. And I know that has people worried. That's also affected the markets. I mean, it's not just inflation right now, but the markets overall have been really yo-yoing around and really volatile. So, Anthony, to start us off, give us a few tips. Like, let's start with inflation, and I'm sure some of this can tie into dealing with market volatility as well. But I assume that to help deal with inflation, you have to first, you help your clients with this, and especially in retirement planning, you account for inflation. But how do you do that? How do we hedge against inflation? I assume it's where our money is allocated or at?
Well, it is. I mean, how the money is allocated and how your investment portfolio is structured, there are assets and asset classes that will typically, and when you look back in history, with inflationary periods, there are certain asset classes that will do better, and certain sectors of the economy that will do better in inflationary times. So that's one way to hedge. As an example, Tony, and, not to get into all of the investment choices out there, but they are these Treasury inflation protected securities. The acronym is TIPS. And these are, government bonds that are built to be very durable in inflationary times. So, for your bond allocation and your portfolio, having some of these tips, these treasury inflation protected securities, can be one way, again, in your fixed income portion of your portfolio to hedge against inflation. Also, these big blue chip dividend paying stocks, Tony, typically, companies that have really good profits that pay dividend to the shareholders. These companies typically are much more durable, these value companies, if you will, Tony, that are much more durable in inflationary times historically than these high flying growth stocks, if you will. So, again, you can hedge that way. And I will say, Tony, in terms of the distribution, and we saw this with the increase in Social Security, you do have what's called COLA in your, that's another acronym for cost of living adjustment. But if you have those COLA increases, like you saw, for instance, in your Social Security benefits this year, for those of you that are drawing, you saw a pretty nice increase in your income because of the cost of living adjustment. And your investments themselves should have some COLA increases along the way. I mean, there's no secret that things are going to cost more. We've seen inflation through the years. Now, let's face it, it's been certainly dramatized. I mean, as you mentioned earlier, I mean, the cost of fuel and groceries, and
Oh,
I
yeah,
mean, it's just going off the charts right now, Tony.
it is.
Supply and demand had a lot to do with that, obviously, with COVID and coming off of COVID. So then the workforce, and they don't have the workers, and they don't have the truckers, and so supply and demand plays a big role in that too, Tony. But to answer your question, your portfolio, how it's invested, how it's structured, and your distribution strategy should go a long way in helping minimize the effects of these inflation.
Sure. Well, let's talk about some of the places your money shouldn't be or won't help you when it comes to inflation. And I assume under my mattress or in a coffee can in the cupboard, that's not going to be good for inflation if I have my money in those places, is it?
No, it's not, Tony. But in our investment strategy, in our retirement plans, we focus on three aspects of an investment strategy, and one would be liquidity, so emergency funds like the coffee can, but of course that not the coffee can, but an emergency
Sure.
fund, and then a structured income plan, and then of course a growth portfolio.
Sure.
So if you've got that liquidity carved out for emergencies, and you have a structured income plan that has inflation built in and the cost of living adjustments built in, and you have a growth strategy, then even if, because we got to figure the markets are going to be volatile. If we're going to retire and we're going to be in retirement for 25 or 30 years of retirement, obviously there's not going to be a linear straight, rise in the stock market. So there's going to be corrections. There's going to be volatility along the way through the years. But if we have an investment strategy that really gets that, it doesn't have to derail your retirement.
Right. And that's the key. And so, there are things where, if too much of your money are in a bank savings account or CDs at the bank, they're going to earn very little, hardly
Correct.
anything, and they're not going to keep up with inflation. So you have to have some money in growth. But at the same time, you're right. It starts with an emergency fund and having that money liquid. But then you need a spending plan and a plan that's going to make your money work for you, especially money that you're going to need in retirement. Correct. And that's what people have to look at. And I know people heading into retirement or already in retirement, they get really concerned about inflation.
Well, they do, Tony. They get, and rightfully so, they get concerned about inflation. They get concerned about market volatility. I mean, if you look back just, January 3rd, January 4th of this year, I want to say the Dow was somewhere around 36,500, 36,600 points. I mean, now we're hovering around 33,000. I mean, it's down a good bit from the beginning of this year, the Dow Jones and the market as a whole. And so, but again, if you have an investment strategy and you're drawing your income from investments that aren't subject to that market volatility, and you have your liquidity, so you have your emergency fund, you have your structured income plan. Well, sure, some of your growth portfolios are going to be down. But again, that's buying opportunities, Tony. That's rebalancing opportunities. So it's really more of an investment strategy in retirement, certainly. Because it's a distribution phase. We're in kind of this preservation and distribution phase. So I guess what I'm saying, Tony, is we shouldn't be, our retirement plan can't be derailed because, there's some war going on
Sure.
across the globe, or there's a big spike of inflation. We have to anticipate those things and build a retirement strategy and an investment strategy that understands that it's not going to be a linear line straight up. We're going to have volatility along the way, and we need to have an investment strategy that gets along with that.
Yeah, agreed. I think that's a great point. And you know what? We should probably take a quick break here. But before we do, Anthony, let our listeners know how they can get a hold of you and have some reports run. I know you're willing to meet with them and talk with them, and there's no charge or obligation for that initial consultation.
No, there isn't, Tony. And crescentcityretirement.com is a great place to start. We do have retirement workshops we do every month. Next week rather, we'll be at Fleming's. And so if you're listening and you'd like to come to one of our retirement workshops, you can give our office a call at 504-828-2171. It's a really nice meal, and we talk about retirement planning in person. That's in Metairie, right here at Fleming's. Or if you'd like to come and just have a phone conversation and just kind of discuss your own retirement plan, we're happy to do that, Tony. We do have a special offer, and I would like to make that offer right now.
You've been listening to our shows and advice on getting your finances in order and creating a retirement income plan that will last. Now is the time to take advantage of our special offer. This is Anthony Kangemi of Crescent City Retirement Group, and we're now offering a complimentary gourmet dinner and retirement planning workshop, the 5 Keys to a Stress-Free Retirement. This is one workshop you won't want to miss. Call in the next 20 minutes for this no-cost offer. Seating is limited. Call Crescent City Retirement Group within the next 20 minutes at 504-828-2171. That number again is 504-828-2171.
And welcome back to Retirement Keys. I'm your co-host, Tony Shore, and I'm here with our host, Anthony Kangemi of Crescent City Retirement. And Anthony, great show today. We spent the first segment talking about inflation, and it's been going nuts. I've noticed gas prices and food prices especially, and I know some people who were trying to build a home or do some remodeling, and it's just the cost of materials. It went up during COVID, but it's just gone up even more recently. And I think some people thought maybe the rise in prices was a blip last year, but it's continuing. So it is important to have a plan in place. And I think what I got out of what you were telling us in that first segment is the key is to have a plan that takes into account things like inflation, correct?
Absolutely. I mean, I don't think that market volatility or inflation, the cost of living going up, or market volatility. Obviously, we can go back on 100 years of the Dow Jones and look at a chart and see that there have been, inflationary periods, there have been deflationary periods, there have been bear markets and bull markets. And, we see all of this, and we know that this is part of it. So it really shouldn't be a surprise. Now, certainly it's not it's not comforting, when you're in the middle of it. But if you have a plan, Tony, and you've already anticipated that there'll be some market volatility, and Tony, we do a whole color of money, report, we talk about red money and green money. Well, of course, the green money is the money that's not subject to market volatility, that can be structured for income and other things. So you just have to have a balance, Tony. It's like, you know, all of too much of anything is not good. So the question is, what is the balance? And how do we structure our distribution strategy, Tony? And, at the end of the day, I mean, when you're working and you're saving and you're earning an income on the job and you're putting money in, let's say, to your 401k or your retirement plan, I mean, it's kind of set, it's automatic. I mean, every 2 weeks, money comes out your check. The company might make a match, but it's really kind of plug and play. It's automatic. But when you get closer to retirement, fundamentally, Tony, things are going to change drastically. In one, scenario, in the accumulation phase, you're working and you're saving. But in the retirement phase, you're really trying to protect what you've saved. And then now you move into the distribution phase. So you're not putting money in anymore. You're taking money out. And so, right off the bat, if you say, well, yeah, gee, I'm not putting money in anymore, I'm taking money out. Well, then, obviously the strategy has to look different because it's completely different.
Yeah, it's almost a 160 degree or a 180 basically.
180
Yeah,
difference.
it's a
I mean, it's
180,
polar
yeah.
opposites. In
Yeah.
one scenario, you put money in. The other scenario, you're taking money out. So this distribution phase, Tony, and how that works with your bond ladder, your annuities, your Social Security strategy, your dividends, how all that works together to structure an income plan, Tony, is so important. And then, as I mentioned, you need liquidity. So that money that you were mentioning that's sitting in the bank or sitting in a money market account, no, it might not be earning much interest, and it might not be keeping up with inflation. That's all true, but it's liquid. It's your emergency fund. And so it's serving a purpose. Then your income plan is serving a purpose. And then, of course, your growth strategy is serving a purpose. And if you don't get that mixed up and you really have that structure in place, then the blips in the market or the correction in the market, even if it's a couple of years where you're in a down market, these are buying opportunities, Tony, as long as you have that base income structured and covered. So it's really more about an investment strategy, if you will, than any one investment, Tony.
So there's been a lot of upheaval, and that makes people make mistakes, right, with their money?
Oh, absolutely.
They get emotional.
People look at, all what's going on, like you say, in Ukraine and Russia and where that's leading and heading us. And as you say, inflation and the rise, the cost of the goods and services. And so, yeah, it has people nervous. So then a lot of times they do make mistakes because they don't have a plan. They just have their money invested, and then now they're concerned about losing the money. Or the stock market is going to be too volatile. So they want to try to time all of this. And so all that is a result of just not having a strategy, Tony, or a good investment strategy, a good structure. I mean, we can't do anything about inflation. We can't do anything about the war in Ukraine. We can certainly have our opinions. We can certainly voice our opinions, but really we don't we have very limited effects that we can have on the situation. But what we can be 100% control of is our own economy, our own retirement plan, our own investment strategy for ourselves, for our families, for our kids, and even for our grandkids. We do have 100% control over that. And I would say that if you've got a good plan in place, we know there's going to be market volatility over the years. I mean, if somebody's going to retire and spend 25 or 30 years in retirement, and if it's a married couple, is very likely that one of the two are going to live those 25 or 30 years in retirement. And it would be not very plausible to think that it's going to be rainbows and sunshine all through those years. We're going to have volatility. We're going to have inflation. We're going to have hiccups in the market. But if we have an investment strategy that understands that and is built for that, then it doesn't derail your retirement.
Yeah. Yeah, that's the key, is to have that plan in place. And a lot of the things people can do, again, it comes back to where your money is allocated. How is it working for you? Making sure you don't have too much at risk or too much in safety where it's not keeping up with inflation. There has to be a balance. And there are so many tools and vehicles now for people for their money in retirement to ensure their retirement savings against these things, and to make sure it's going to be there when they need it. And that's the key, is to be able to live comfortably in retirement. And I think that's a big fear people have is, am I going to have enough? Am I going to run out of money in retirement? I bet you get that a lot.
Yeah, I mean, it is a concern, and if things aren't set up properly, I mean, it is a concern. I mean, if people are pulling money out of the wrong, portfolios at the wrong time, if things aren't structured properly, I mean, conceivably, you could be pulling money out of a let's say a growth portfolio that's down, and then you're selling assets at the wrong time to generate the income that you need in retirement. Well, I mean, that's the nail in the coffin, when if you're pulling money out of the wrong accounts at the wrong time. So having that distribution strategy and knowing what accounts we're drawing from and how those accounts are invested to be the income for the period of time that it's allocated, is so important. I mean, you really need an investment strategy and a distribution plan. And, Tony, with that retirement compass, and you're familiar with the compass, I mean, it really, and I know there's other, retirement distribution planning software, but that retirement compass is really state of the art. I mean, it pulls together the Social Security strategy and the investments and the bonds and it pulls it all together, any kind of defined benefit plans. And we structure that. And I tell you, Tony, it's like a roadmap. I mean, it's like blueprints. It really is. It's a phenomenal piece of software. And as I say, I'm sure there's other planning software that's very good. But I'll tell you, when clients see their retirement compass and see exactly what the distribution plan looks like, and we even look at the taxes, the federal and the state taxes and the net income, and we factor in Social Security and Medicare and the whole bit. I mean, it's really, the retirement income plan is really a foundational piece to any investment strategy in retirement. And that compass is really award winning. It's state of the art. And so I would just encourage our listeners, if you don't have a retirement income plan, or at least one, one that you can put your hands on and say, this is exactly what my income's going to look like in retirement. This is what the distribution's going to look like. This is where the money's going to be pulled from and when, then you owe it to yourself to get your hands on your own personalized retirement compass, which we want to do for you. We're happy to do it free of charge. It's complimentary. Give us an opportunity to put that retirement income plan in your hands so you have something to compare.
Well, sure. Yeah, I think that's huge. And I like that. And I love the fact that you can also run certain reports like the Morningstar report and the Social Security Maximization report that's really based on each individual or each couple's unique situation to show where they're at and how much risk they currently have and where they need to get to as far as their, savings and investments. And the Social Security, that's the foundation, as you say. And really, you want to maximize that. So if any of our listeners haven't yet filed for Social Security, or they've recently filed, they should meet with you and have that report run to make sure that they're doing the right thing. Now, all that can be gathered, and there's no cost for that consultation, for the initial consultation. How do people get a hold of you once again, Anthony, to set that up?
Please just go to crescentcityretirement.com. You can look us up there. All of our shows, our radio shows, are archived. Our workshops and educational events are all laid out there. So you can go to the website at crescentcityretirement.com to get more information, or you could just simply call our office at 504-828-2171 and just ask for me. We'll schedule a phone meeting. We'll visit over the phone and see if we can't get you those reports. I would say the Social Security Maximization Report is a must. The Color of Money Report is certainly a must. The Retirement Compass, I would say, is an absolute. And so if you would like those reports and you would like to see how your trajectory of your retirement looks like, we've got the reports to show you exactly where you are and where you're headed. And so really, we hope you take advantage of that. I mean, we appreciate our radio audience. I've always loved talking to you when you come to our little workshops. I have a lot of our radio listeners do come to the retirement workshops, and we really appreciate you coming. And so we just, hope to be a good resource for you as it relates to retirement. So just thank you so much for joining us. And please reach out if you'd like to get a second opinion.
All right. Well, thank you so much, Anthony. And listeners, that does it for today's episode of Retirement Keys with our host, Anthony Congemi. Thank you for listening to Retirement Keys. Don't pay too much for taxes or retire without a sound income plan. For more information, please contact Anthony Congemi at Crescent City Retirement Group. Call 504-828-2171 or visit the website at crescentcityretirement.com. All matters discussed during this show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. Anthony Congemi and Crescent City Retirement Group are not affiliated with or endorsed by the Social Security Administration or any other government agency.